Most conversations about wealth focus on one number: your salary, your savings rate, your net worth. As if there's a single figure that, once reached, means you've made it. But the closer you look at how money actually accumulates, and more importantly, how it behaves at different levels, the more you realize that wealth isn't a destination, it's a series of completely different games, each with its own rules, its own logic, and its own ceiling. Today, we're going to walk through 6 distinct levels of financial life, not as motivation, not as fantasy, but as a clear-eyed look at how the relationship between a person and their money changes as the numbers grow, and what actually separates each level from the one above it. Level 1, the high earner. The first level looks, from the outside, like success fully achieved. Someone at this stage might be earning $300,000, $400,000, even more annually. They work in a demanding field: finance, law, medicine, technology. The income is real, the lifestyle reflects it, and by any conventional measure, they've done exceptionally well. But there's something this level reveals, almost quietly, to the people inside it. Income, no matter how large, is linear. It arrives in cycles, it's tied directly to time worked, it grows incrementally, one promotion, one raise, 1 year at a time, and when the work stops, it stops. The first crack in this picture often appears when a high earner sits across from someone operating at the next level, a private investor, a fund partner, a business owner. The income gap between them might not be what you'd expect, but the structure of how they earn is entirely different. The high earner earns compensation, the person above them holds positions. That distinction, once noticed, is difficult to ignore. Level 2. The accumulator, net worth $2 million to $5 million. At this stage, something mathematically significant begins to happen. The investment portfolio is no longer a background detail, it starts to have a voice in the conversation. A strong market year might add $300,000 or $400,000 to the balance, an amount that begins to rival, and occasionally exceed, what a year of working produced. For the first time, capital is generating meaningful capital. This is when the financial priorities typically shift. Simple index fund investing, which served well at earlier stages, begins to feel insufficient, not because anything is wrong with it, but because the questions being asked get more complex. Tax efficiency becomes a serious consideration, asset allocation becomes a deliberate practice rather than a default. Private banking relationships often begin here. The language changes. Retirement planning gives way to conversations about portfolio construction, private credit, and direct real estate. The framework is no longer about saving enough, it's about compounding what's already there. Social patterns shift subtly too. Conversations that once revolved around career advancement begin to include investment opportunities, ownership stakes, and deals. The peer group starts to look less like a group of earners and more like a group of capital deployers. The objective at this level isn't income, it's compounding, and the distinction matters enormously. Level 3, the investor, net worth $10 million to $20 million. Somewhere past the $10 million mark, a meaningful threshold is crossed. Work becomes optional. Not in the sense that most people imagine, not idle or purposeless, but structurally optional. The portfolio, in a reasonable market environment, can generate returns large enough to replace a professional salary without requiring anything from the person who owns it. What changes most noticeably at this level isn't the lifestyle, it's the type of opportunities that become accessible. Private markets open up, deal flow that never appears in public markets begins to circulate through networks. A venture fund offers a co-investment, a real estate operator extends an invitation to participate in a private acquisition, a former colleague launching a credit fund makes a call. These opportunities don't come through advertisements, they move through relationships, and access to them is largely a function of being at this level of capital in the first place. The shift in mindset here is from growing wealth to deploying it. The investor at this stage isn't simply allocating to funds and waiting, they're participating in transactions, accepting that some will underperform, some will fail, and some will return multiples, and building pattern recognition across all of it. Private ownership starts to replace public market exposure as the primary driver of meaningful returns. Level 4, the owner, net worth $50 million to $100 million. At this level, the relationship to capital becomes direct in a way it hasn't been before. Owning a share of a publicly traded company is one thing, owning a controlling or significant stake in a private business is something structurally different. The distance between capital and consequence collapses, revenue growth isn't an abstraction, it's visible. Cost pressures aren't a line item in a quarterly report, they're a decision that needs to be made. People at this level often sit on boards. They participate in acquisitions not just as capital providers but as decision makers, helping shape strategy, evaluate leadership, approve major expenditures. This creates a different kind of accountability, and with it, a different kind of return. The compounding that happens when you own a business with the ability to influence its direction is categorically different from the compounding that happens when you hold a stake and observe. Ownership, at meaningful scale, is active, and the upside reflects that. The frame of reference also shifts. Portfolios of stocks and bonds, which were the primary instrument at earlier levels, become one component among many rather than the central structure. The owner thinks in terms of enterprises, not positions. Level 5, the capital allocator, net worth $500 million plus. Beyond a certain scale, the nature of the game changes entirely. Individual companies are no longer the unit of analysis, capital flows are. At this level, wealth is typically held across a range of structures, holding companies, private funds, managed vehicles across multiple sectors and geographies. The role isn't to analyze individual investments, teams of people do that. The role is to decide where capital moves, and in what proportion. Conversations at this level involve fund managers, institutional investors, and in some cases, sovereign entities. The decisions being made, which sector to increase exposure to, which geography to enter, how to position across credit and equity, can redirect hundreds of millions of dollars within a relatively short time frame. Capital, at this scale, behaves less like a personal asset and more like a current. It flows through industries, influences markets, and shapes the environment that smaller investors are operating in. What's striking about this level isn't the numbers, it's the abstraction. The person operating here is rarely thinking about a specific company's prospects. They're thinking about the architecture of where capital should be, and what that positioning implies for the decade ahead. Level 6, the architect. The final level is, in many ways, the hardest to describe, because it operates largely out of view. Wealth at this stage isn't held in a brokerage account or even a single family office. It sits inside layered structures, trusts, holding entities, investment vehicles spread across multiple jurisdictions. The goal isn't growth in the conventional sense, it's preservation, perpetuation, and influence over time. The conversations at this level aren't about deals or returns, they're about capital mandates, where large institutional pools of money will flow over the next 5 or 10 years, pension funds seeking yield, governments seeking infrastructure investment, global markets requiring liquidity. The people at this level help determine where those flows go. And that's the insight that only becomes visible from inside it. The real architecture of capital isn't something most people ever see, because it operates several layers above the decisions that are publicly visible. Markets respond to this layer, industries are shaped by it, and yet, because it operates through structures rather than personalities, it rarely appears in the conversation about wealth in the way that salaries and portfolios do. What this actually means for you. So why does this framework matter for someone who isn't anywhere near these levels? Because the principles that move someone from one level to the next are the same at every scale, they're just applied with different amounts of capital. The shift from level 1 to level 2 happens when someone stops treating income as the primary metric and starts building assets that generate returns independently. That principle applies whether you're earning $50,000 or $500,000. The shift from level 2 to level 3 happens when compounding is prioritized over consumption, when the portfolio is protected and allowed to grow rather than continuously drained for lifestyle. Again, the scale is different, but the logic is identical. And the shift from thinking like an earner to thinking like an owner, the idea that the real leverage in building wealth isn't in working harder but in acquiring assets that work independently, is something anyone can begin applying, at whatever level they're currently at. The levels don't change the rules, they just reveal them more clearly. Closing. Understanding how wealth behaves at each stage isn't about aspiration or comparison, it's about clarity. When you understand that income is linear but ownership compounds, you make different decisions. When you understand that the most meaningful financial shift isn't a number but a structure, you start to see your own finances differently. Wherever you are right now, building an emergency fund, paying off debt, just starting to invest, the principles operating at the highest levels of wealth are already available to you in a form that fits your current situation. The question is whether you can see them clearly enough to use them. If this gave you a clearer picture of how wealth actually works across different levels, subscribe to the channel. We cover personal finance the way it actually operates, with clear explanations, honest analysis, and no shortcuts left out. I'll see you in the next one.